Thomas Swiertz is a founding manager of SDCC, Smart Derivatives Contract Clearing. Now, SDCC is a market-leading optimization provider that reduces counterparty risk and capital requirements to increase the efficiency and the transparency of the derivatives market. So Thomas is here to explain exactly what SDCC is doing. So let's just start with that. Give me an overview.
Yeah.
How does this work?
SDCC is Smart Derivatives Contract Clearing, and we do DeFi clearing, so decentralized clearing. We are a market infrastructure provider and a calculation agent for participants in OTC derivatives markets.
Okay, so who uses your services?
Mainly banks, but also corporates and anyone who is trading OTC derivatives like interest rate swaps and other OTC.
Okay, and what is the benefit to using SDCC?
We have currently a lot of regulation going on, Basel rules, which are global rules. We have Dodd-Frank in the US, we have EMIR in Europe, and the increasing capital costs are a burden, of course. And we lower this margin requirements, and we make the settlement more efficient.
I see. So that's why they like to use you. They can still be involved in these markets and reduce their risk, but they don't have to put up as much margin.
Exactly.
Got it.
And
okay.
Plus the smart contract is also enabling counterparty risk to be vanished, basically.
Okay.
So rating doesn't really matter. We have a pre-funded default buffer, which works very similar to a clearinghouse, but with less margin requirements.
Now, smart contracts, so are these blockchain-based contracts?
Yes,
okay.
they are. I kind of tend internally to say we don't use the word blockchain anymore.
What do you
use? Well, persistence layer or a Java repository, because kind of when you hear blockchain, you often get Bitcoin and all the crypto stuff, and we use blockchain as a technology rather than issuing any coins or crypto.
Sure. Well, people forget blockchain is a technology that has tons of applications, and one of which is Bitcoin, but it can be used in a lot of other industries as well.
Exactly.
So, now, let's talk about this Sandbox Consortium. There's 20 banks that you're working with. Explain that, and why is that important?
Yeah, we kicked off already with the first interest rate swaps in 2021 with German banks. And now we would like to have a larger liquidity on our platform. So the idea is now to invite up to 20 banks. We guess we will be oversubscribed, so we have to limit it. And the idea is now to have a questionnaire with the participants. What kind of OTC product do you like to trade? We match them internally, and then we kick off a consortium, which will have also a strict regulatory audit, which is important because we are not only a risk tech, but also kind of a reg tech.
Yeah. Now, would that consortium prevent something like Silicon Valley Bank or the regional banking crisis that we saw in March of this year?
This makes our topic very topical again, with Credit Suisse or Silicon Valley Bank. The whole industry started, the idea of margining started with Fleeman. And now we see kind of concentration risk with the so-called central counterparties. And we are a calculation agent, and we introduce bilateral margining in another way.
You're based mainly in Germany.
Yeah.
How do you see European regulations versus US regulations? Is that hard for you to kind of toggle back and forth? Or
it's kind of the same, because it is a global demand. We are working in international markets. So a US bank is doing business with a German bank, is doing business with a bank in London. And we have two subsidiaries, one in London, one here in New York. And it's global business, so we have to be global. And most of the rules are very similar. Yeah, you have to introduce margining, you have post-collateral, you have to do trade repository reporting. It's like a tsunami of regulatory demands which bank or asset managers.
It's maybe the most regulated industry in the world, financial.
Definitely.
Things.
Yeah.
So, I mean, and there's a lot of regulation out there. What do you see for the future for SDCC, and then just the future of this industry?
I think that the industry is now facing two things, basically. One is the higher capital rules, which come from the regulation. The other thing is currently interest rates are rising or are high, so it matters if you have more liquidity.
Yeah. And what about interest rates? I mean, do you see those continue? We had an unbelievably long time of zero interest rates. I mean, now they're just kind of normalizing. What do you think about that?
I think we will have a higher interest rate for longer than the market expects.
Really?
But in a way, we are not market participants. So it will be our participants who decide. And they will hedge. Will interest rate go up or down?
I guess time will tell. So that certainly would be more normal historically to have higher interest rates. So Thomas, thank you so much. Always interesting to have you here and great to have you at the NASDAQ.
Jane, thank you very much.